Thank you all for being with me, and thank you all for staying with us throughout the day. This is a fantastic session before your dessert this afternoon with Zlatan. The topic for us is valuation, and Kieron, who you guys may know as the Swiss Ramble, is also in the investment banking business or in the banking business. Kieron, what is your view of some of the recent deals we've seen in football? And maybe we could begin with AC Milan, which will be a topic in the next session.
Okay, so AC Milan is a good example from one perspective. It's a bad example from another perspective, namely, I got it all wrong because I sat here a year ago just after Redbird had invested something like 1.2 billion to buy Milan. Obviously a great football club, a great brand. I used to live in Milan. I had a season ticket there for 3 years, so it's a club close to my heart. But I was puzzled at why they would buy them, because Italian football has been in the doldrums. If you look at the traditional big four in Italy, so Milan, Inter, Juve and Roma, they'd lost something like 2 billion euros in 3 years between them. The Milan themselves, they'd lost money for 16 years in a row. So I thought, it's a bit of a brave purchase, to say the least. But in 12 months, there's been a bit of a turnaround. So they've done it the old-fashioned way by increasing revenue and keeping a lid on costs. And they've done the way that they've increased the revenue is the best way. So they've been successful on the pitch. As one of the panelists told us earlier, Italian clubs have been very successful in Europe. That included Milan. They reached the Champions League semi-final, which helped. They also made good use of the brand and increased commercials. They increased their revenue by more than 100 million. And they did actually generate a profit, 16 million, which is rare in the world of football. It's also particularly rare in Serie A. So they showed that one of the tenets of why would someone invest in a football club, how it can come true, which is that people will think as investors, we could probably do a bit better than the incumbent and bring their skills and knowledge from other sectors and clubs from other countries and even continents and apply that knowledge to bear. So they had managed to do that, which I think is a sign that these things can be done. I mean, Italian football, I would say, is still not out of the woods. That there are issues there with the TV deal. There are issues about whether they can get any stadium investment approved. Milan obviously looking at that. We saw that in the last session, Inter as well. But it just shows that things are not always impossible. So I got it wrong, they got it right.
And coming to the UK, it seems like every year in the Premier League there is a club that captures the imagination, and this year it's Aston Villa. And obviously there's just been a transaction to sell a 20% stake at a roughly £500 million valuation. What is your takeaway on the Villa situation?
So Villa's interesting, and when you were speaking earlier, you quoted Nassef Sawiris saying that if anyone treats a football activity as a pure investment, in 95% of cases he's a liar. And if you look at Villa, I think that any fan of that club would say that the owners are good owners. First of all, they rescued them from what was a bit of a financial crisis, to say the least. They then guided them to promotion to the Premier League, and they've qualified them for Europe. So that's all good, but it's come at a price. So in the 5 years that they've owned the club, Villa have lost something like 300 million. And without the sale of Jack Grealish to Manchester City, that would have been 400 million.
And this new capital injection, I assume?
New capital injection. So that also, there's two ways of looking at what would an owner get out of a club financially. One is you look at the sort of operating finances, and they're not great. Some clubs turn a profit, but the vast majority lose money. But where you can gain is on capital appreciation. So there's that recent investment by Tyros for a minority stake, and that that would value Aston Villa at something between 500 million and 600 million, which is a significant return on the money that they paid when they came into the club. So, as always, it's a bit of a mixed bag. You look at the bottom line, you think, oh, that's pretty horrific. You look at the capital gain, you think, well, that's not too bad.
Well, Tom, we'll come to you in a second to talk about Birmingham and other opportunities. Ian, you worked on both those deals. What have you learned in the process of advising on some of these transactions, both from the legal sense and maybe where else you can talk about it?
Yeah, I suppose. When I first got asked to be on a panel on valuation, I was thought maybe it would mix me up with someone else because I'm not sure that's necessarily where the lawyers always come in. But I think one big takeaway for me that goes to valuation, I think probably the future view on valuation is seeing this smart money that continues to want to flow into football. Now, as a lawyer, I'm not going to be the one preparing a discounted cash flow model and giving a view on revenue multiples. But when you see investors like a Taros, like Clearlake at Chelsea, like Redbird, like the queue of top investment firms who wanted to invest in the German media rights recently, I think that's got to give you confidence that these people, these very smart investors who continue to want to invest their money and ultimately their LP's money into football has got to bode well for the future.
Jim, you're at a firm typically associated with being smart money, and you guys have found multiple ways. Can you maybe explain?
I should have mentioned Aries in that list.
I noticed you didn't.
I didn't want. I was sparing your blushes, to be honest.
Can you just explain to the audience what sort of fund you use first? Because I think it's important to clarify sort of what kind of investment tools you guys have at Aries.
Yeah, sure. We purpose-built our sports business for this end market. So it was built with patient capital, long-term capital, which I think is critical for the comfort of leagues and teams who are on the receiving end, and because there's oftentimes where the interim period can be somewhat volatile, but so the need to sell or exit is not a focus or priority for us, and so we created a fund that was designed to invest in sports, both up and down the balance sheet, so everything from debt through equity. U.S., Europe, and Asia, so it can you can see some diversification across those markets because they all behave a little differently as well. So there are a variety of attributes that we put together to make that hopefully successful for the long term.
And in terms of this year, you guys have been deploying quite a bit of capital into the space, right? Into European clubs.
Yeah, we've been pretty active, and we look at a lot of transactions. I think we have a pretty unique lens at seeing performance both financially and on the field and operationally. And people will ask, well, I think the theme here is what's going on with valuations. It feels like there has been a step function change, and if you go back in time, that's actually pretty typical. You see these step function changes in valuation, and then it tends to be normalize a bit, but there's always, going back 10, 15 years, you can go back and say, I can't believe someone paid that price for this asset, and it typically becomes the norm. It doesn't define the market necessarily, but it can often set a standard for the next handful of assets that come to market.
Your thesis is that people are not overpaying and that we're moving into another stratosphere.
No, I actually wouldn't say that. I'd say there are certain places where scarcity value, it's supply and demand, and there's just it's difficult to put financial numbers around a very rare asset where there's a number of buyers who want to own it, and it may not conform to the financial numbers. I don't think we should look at that as the metric. I actually think you can look more broadly. You still see the theme of rising valuation and maybe a step function, but I'm not sure I would look at Man United specifically or some others that have been in the market that are really high-profile brands. They also have a different set of attributes to be valued. I think more broadly, you look at media rights, and it's really international media rights. You look at the fixed asset pool, the way to monetize that through stadium revenue and other resources. You can look at globalization of the brand. So that's another important thing that's just really in the beginning of monetization for some of the mega clubs, but that doesn't always exist for every asset. And the difference between Italy and Spain or Italy and the UK are quite different. The supply of buyers in Italy is just going to be less than there are in the UK, for example. So you have to value each one uniquely and separately. Size of the club matters as well. So there are themes that you can see, though, that are clear, and I don't think the secular trend is going to shift. I think it's positive and reasonably stable, but it's it's hard to say over the next couple of years whether you'll see some reversion to a mean or maybe some softness. But
Okay. Jim's being shy, by the way. I reported in September that Ares lent around 500 million pounds to Chelsea, but he's not elaborating on that for you guys. But so this is someone deploying serious amounts of cash here in the UK. Tom, looking for another Birmingham dream, I suppose. But how long were you evaluating the landscape before you alighted upon the Birmingham City opportunity?
Well, before we closed, we spent the better part of a year and a half looking at English football. A year of that time was spent looking broadly and understanding the landscape. And then we spent a number of months negotiating and documenting what was a very complicated deal in Birmingham. So we certainly have done this for a much shorter period of time than in many others. I think we learned a lot in a short period of time, and we were lucky to find great people to help us in the journey. Gary Cook, our CEO, being the person who sits at the top of the heap and has been a big reason why we were comfortable with the transaction.
And I mean, your background has been, or at least I don't know if some people are aware that you're very much affiliated with the turnaround at Hertz Rental Car, which is a big American rental car company. I mean, are there lessons from being a distressed investor in taking over a club that maybe, I don't know if you want to use the term distressed, but Birmingham City wasn't in the greatest shape when you arrived?
Yeah, I would say that we're turnaround investors. I'm not going to call my club distressed by any stretch of the imagination. I think what I would say is that it was a club that had failed its community. And I mean that in every sense of the word. There wasn't a great deal of attention being paid to our various constituents. And in Birmingham, being the named club in England's second city, there's a responsibility to excellence that I don't think we can ignore, and I think we must live up to. And so if we take that as a guiding principle, and we make every decision with our constituents in mind and with the community in mind, even if they might support another club, they're still part of our community. I think we'll do okay. And so I would say that it was, rather than distressed, I would say that it was misguided. And part of what we do in turnarounds is to reframe the strategy of a business. And that's certainly been a huge focus at Birmingham. I mean, there's the standard things that we'll do with a focus on revenue, and we can talk about that. But at its core, it's really changing the culture of the club to live up to the appropriate expectations of the community.
And you obviously got a lot of publicity right when you came out with the deal with Tom Brady's involvement. So how did yeah, exactly.
Oh, the other Tom.
The other Tom,
yeah. Okay.
The other Tom.
Yeah, he's been a fantastic part of the story. Tom is, people say, oh, it's like some of the other famous Americans who have come into English football. Tom is doing this because he's a competitor, he wants to win, and he wants to make change. And that really relates in all elements of the club. He wants to help drive revenue, he wants to think about excellence on the pitch, and he wants as a particular focus in excellence in health and wellness. And that's not just a catchphrase that he used to explain why he was doing freakish things in American football at a relatively advanced age. I won't call him old because he's younger than me. But I think it is something that drives how he thinks about life. And he's going to make a huge impact. He and his team at TBRX will make a huge impact at Birmingham over time. And
did you see that? I mean, when you were thinking about making an investment in football, did you see, knowing that you have that relationship in your back pocket, and that was that an opportunity, a value driver that people don't think outside the box about?
100%. If you look at the great competitors in sport, there are a lot of similarities, right? If it's, and I won't name any in English or European football because I don't want to insult anybody, but if I use American sport, you look at the Tom Brady's of the world, Michael Jordan. These are gentlemen who are competitors that every element of their life is in extreme competition, and they have to achieve excellence in everything they do. And so I knew that having Tom on board would drive us to excellence because the expectations from him would be very high. And when we win or lose a match, there's always a phone call, that comes over asking what went well, what could we have done better, what are we going to do in the future, and it's driven by his desire to constantly improve. So I don't think we would have done the deal if Tom hadn't been involved.
Absolutely. All right. Well, thank you for that. Kieron, one of the big topics, again, outside of the football world has been interest rates and the cost of money. The free money period is over, although we are now kind of at the tail end of the interest rate cycle in terms of people believe rates are now coming down in the foreseeable future. Do you think we're going to see a lag in the sort of feed through that slowdown in acquisitions and in valuations is going to feed through now in the next 12 months, and it will take a while for that to reset? Or, for instance, at the high level, this past year was dominated by the Manchester United story, the year before that Chelsea. Perhaps we'll see, I don't know, this year the Tottenham will be the story for the next 12 months about a takeover there. Do you think we're headed for a slowdown, or there is going to be continued activity and higher prices?
I think there'll be continued activity, but I think it might be different because I think there's probably be less activity at the top end. Someone earlier mentioned about scarcity of assets, and there are only a few really big brands. So I think the activity will probably change in direction with people looking at smaller clubs, maybe even looking at sort of, clubs in Division 2 and Division 3. Because if they're looking for upside, that's the best way to do it. I mean, it's risk-reward, but if you can take a club in the second division and speaking for England, get it promoted to the Premier League, then you have a step change in your financial situation. I think people will also look at more investments of minority stakes. There was a sort of drive to have control, but minority stakes, we saw it with 12.5% in PSG, and even United, you mentioned, that's 25%, 28% now. But I think that a big part of that will also be probably more multi-club ownership, but different types of multi-club ownership, because some look at that as a specific strategy. Some almost do it by accident. They sort of pick up a stake here and there. And I think that's going to be a bit of a hot potato because there are, I think from an investor's perspective, a lot of clear and obvious benefits to that. But the other side of that coin is a lot of those benefits are disadvantages and issues for others. So if you look at sort of player trading and player development, if you've got a multi-club portfolio, it helps you retain talent because you can move people around your stable of clubs. If you're on the outside of that, you're saying, well, they're sort of hoarding the talent. We can't get hold of it. So,
I thought John Textor was fascinating on that.
Yeah, and he's interesting. One of the things he said a few months ago was when he was asked about what's the real benefit of multi-club ownership, he said it's having a global footprint of talent. And so, from his perspective, that's a huge advantage, but it's sort of not that great for the competition.
Jim, I mean, should we interpret the fact that you guys have gotten involved with Eagle football and with Chelsea, with Jones Strasbourg now? I mean, do you guys have a view on multi-club? Should we interpret that, or are these one-offs that it's just a random coincidence?
No, I think I actually heard this morning from one of the other panels, I think it was Fausto, who mentioned that it helps build diversification, so it actually does de-risk individual assets. I fully agree with that. I think it'll help to attract capital because of scale as well, and it can change your access to capital. We're talking about the asset class generally. We think of sports teams as non-correlated, so interest rates and recessions and COVID even didn't really impact meaningfully the top echelon, but that's not true when you get down into the lower clubs.
Yeah.
And having a multi-club system provides an additional level of support and maybe access to the top talent at CEO level, at sporting directors. So being able to offer something bigger than maybe your local club can do on its own, not to mention just some general cost synergies around sourcing talent that we heard from people before. So that gives us comfort, and we like that. It also provides growth maybe in excess of what the asset level can do.
Given your portfolio and footprint, and maybe even mentioning the Ateros transaction, which, if you don't know, Ateros is linked to Comcast. I mean, do we have a view on where media rights are headed? Because there is a growing debate that maybe things are toppy, and there's. I mean, do you guys have a view at areas that the landscape is still quite bountiful there?
I think there's two different discussions on media rights. One is the domestic, and the other is the globalization of media rights. And the international piece, in our view, is very much growth oriented, and then the domestic is
Including the U.S. market?
I think the U.S. market for certain leagues, Premiership, La Liga in particular, maybe
Growth.
Serie A, growth. You'll see others which won't be able to access that, right? But the maturity of local domestic rights is very real. It might even be in decline. And it does come back to you have to have competition when those renewals come up, and there are just not that many players domestically to support it. So that's okay, because the international piece is pretty high growth, and I think we're just in the beginning of seeing competition there.
Okay, so that helps inform some of your guys' decision making to invest here. Ian, women's football has actually been for the first time, really a dominant theme, largely thanks to Michelle for this event. But it seems like it feels very real this time. I mean, you helped structure that deal for Michelle. Well, okay, you were involved legally.
To execute.
You executed the deal. Michelle's the boss. You were
Michelle
executing.
is structuring. Yeah.
She's covering her eyes.
Right. Yeah. And to be clear, the list of smart investors in football earlier, there's no one we've worked with who's smarter or with a clearer vision and
Do you
more
anticipate
ability
seeing
to
more
execute than
more
Michelle.
activity in this space now? And
Yeah, so I think it's really interesting. I mean, I think specifically in this country. So we worked with the FA in setting up the WSL, and the structure of women's football in this country and the ownership by the men's clubs has been great. It's been a boon to women's football, and those clubs have helped get the WSL to where it is now. But with the move to NewCo, there are going to be opportunities. I mean, it was well discussed this morning where the opportunities are going to be in women's football. And there are going to be people, I think, who want to invest specifically in women's football in England. And Michelle has bought the only independent women's football club in this country. So if Aries, for example, wanted to buy a women's team, that's not available. They'd have to go and buy a men's team and spin it out. And I think that is something that does require some thought, because unless we in England create the opportunities for capital to flow into women's football, that it does appear that the demand is there. If we don't allow that to happen, that capital will flow into women's football in other countries, and those leagues, whether it's Jessica and the NWSL or France or Spain, will become the dominant women's leagues in 5 years' time.
Are there legal barriers to structuring transactions the way Michelle did in OLFM?
No, so there aren't legal barriers. It's something that absolutely could happen. I think the question is whether the incentives are there for the current crop of men's club owners, and I think we might see it happen, but I think it does bear some thought as to whether incentives or structures can be put in place to ensure that investment is made, or that opportunities for external investment to flow in are created.
The idea being, can you create effectively within a club structure a vehicle where cash can be implemented directly into the women's,
right?
Yeah, and create an ownership structure that allows a new investor to just participate there.
Yeah, and it's worth it's worth thinking about. Jessica made an interesting point this morning about the real growth of the NWSL. That started when the NWSL span out from US soccer and was on its own 2 feet, and that created this dynamism, that incentive to get to where it has got to. And I think with the move to NewCo happening in women's football in this country, I think there's a real opportunity there. So I think there probably will be activity in that area in the next few years, for sure.
Tom, when you think about what you're building at Birmingham City, are you going to run the traditional playbook of trying to increase match day? What is the sort of playbook you're running, and is there more to it? Is there infrastructure? Is there more ambitious vision?
I think you have to focus on everything, particularly in a large club like Birmingham. It's a big city, a big natural fan base, big catchment area. I think you have to focus on certainly revenue, which is we believe is the most important component by a wide margin. But it's not that you can walk in after years of neglect and simply say you're going to raise ticket prices. I think that's, a disaster waiting to happen. It helps when you buy free pints, as was mentioned. That's a nice way to ingratiate yourself, but I think it has to be a lot more than that. You've got to create a match day experience that is worthy of folks' time. And we're not competing against other clubs in our city. We're not competing against other clubs in England. We're competing against Netflix, Apple, YouTube, and every other form of entertainment you can think about. That's where young people are spending their time, and that's what we've got to try to capture. So that means we need to have a product that is deserving of that time and attention, and part of that is the quality of play on the pitch. Part of it is the story you're telling, and a big part of it is the physical infrastructure. So from day one of our analysis, we asked what are the opportunities to create a new physical infrastructure for the club that is commensurate with our ambitions, and that is very much in the cards.
Absolutely. And let's just break it down a bit. When you talk about revenue, you mean you need to increase revenue because what you need to do is get the best players and pay them the highest wages to improve the team, right? That's what you mean.
That's the way this crazy business works, right? And everyone spends every penny they can to have the best product on the pitch, and we certainly are and will be no different. But we can't compete at 20 million pounds of revenue per year. That's a failing model. And so the first thing that we looked at is how do we grow revenue? And part of that is not simply monetizing your existing fans, but growing your fans. So the first deal that we did was to put a streetwear brand on the front of our kit. Now, it's to take nothing away from some really cool insurance companies and airlines that go on the front of jerseys. But we thought that an LA-based streetwear brand would perhaps garner some more attention. And so it was as a result of Undefeated, which is the brand, selling Birmingham City kit in LA, and young people walking down the street wearing it. One of the biggest young movie stars, English movie stars in the world, called into the office and said, is there a way to get involved?
Who was that?
I'm not going to say. And he said, I can't believe that I've seen this in the streets of LA. What are you guys doing? And so we had a long conversation. And I think, part of what we have to achieve is the authenticity of the story. The reason that I mentioned Tom's involvement is it's authentic. What we don't want to do is have folks involved who are not authentic and aren't tied or aren't serious about being connected to the club. But what is authentic is taking, a gritty working class neighborhood where we're located and showing what I would characterize as a level of respect by putting an appropriate brand on our kit that resonates with that community. It shows that we understand the community, and I certainly hope we got it right.
And thank you to the audience watching online for all these questions. I'm going to try to get through a few of them, and I'm going to come to you guys very shortly for questions for the audience, from the audience. Kieron, financial fair play has been a big topic over the last 12 months. How do you view that impacting valuations? It's interesting. Newcastle, for instance, was seemed to be in a certain upward trajectory, and now that sort of momentum has come undone. Everton's well-publicized travails. Whether Man City ever gets in trouble or not is above my pay grade. But what's your view of the impact of this stuff in valuation terms?
So I think there's two conflicting impacts. One is that if you're buying a club and you really want to spend a huge amount of money and try and advance quickly, which is obviously the case with Newcastle, then it's frustrating because whichever way financial play is structured, whether it's a maximum allowed loss or whether it's a sort of soft salary cap as a percentage, it limits them. I think that what UEFA have done is quite sensible, but as they said earlier, it's complicated. And if you say, well, we're going to get down to a 70% squad cost ratio, if you just look at that in terms of a club that has a 500 million turnover, then that gives them a budget of 350 million. If you've got a 200 million turnover, then your budget is 140 million. So, the competitive ability the competitive imbalance is there. On the other hand, one of the issues that I think holds back the valuation of football clubs compared to, say, American sports is the variability of of revenue and the fact that the clubs just, continue to lose money. So anything that makes it more secure, makes it more likely that people are going to be reasonably sustainable, I think will help them. I mean, I remember when FSG came into Liverpool, they went on record and said one of the reasons we made the acquisition at that point was the introduction of FFP. So, as is often the case with these two things, it's neither completely good from an investment point of view or completely bad. It just depends which stage of the cycle people are.
Ian?
Yeah, I think I'd go a bit further than that. I think, if you look at the financial regulation of football really started in 2010 with the introduction of FFP, and the level of financial regulation since then has, increased steadily. Now, football club valuations since 2010 have done that. Now, whether that's correlation or causation, I think it's at least a little the latter. I think, most investors would say they want to invest in industries that are well regulated, that have clear rules that they understand and they can operate in to the best of their abilities. And I think, there is at times, and it's in the government white paper, a fear that over-regulation can deter investment, and look, bad regulation, I'm sure that's right, can deter investment, but I think good, effective, clear regulation, encourages investment. And investors don't want to lose too much money, and that's what FFP and salary caps bring. And I suppose you look at the NFL, which is the most financially regulated league in the world, with a hard salary cap, with a very onerous acquisition leverage test, central revenue sharing, et cetera, and that's the league that operates at the highest valuation multiples. So, it is more complicated. It does create more work for lawyers. I am slightly talking up my own book here, but ultimately it's a good thing.
Yeah, to navigate the new world, everyone needs a good lawyer.
That's for sure.
Let's get some audience questions going. Please raise your hand and we'll get a microphone over to you. One right there in the middle back. If you don't mind saying who you are too.
Hello, Francisco from Sporting. I have a question on multi-club ownership. I think it's, and we saw also John Texter, it's quite clear what value it creates, the multi-club ownership. However, what we're seeing is also some interest in minority stakes in several clubs, and you spoke about that today. My question is, how do you balance that multi-club ownership between clubs that play in the same competition, especially in European competition? And how that issue should be addressed, and especially the balance between a healthy competition and the creation of value for multi-club ownership.
Ian, do you have any experience navigating this topic?
So we acted for Redbird last summer on their discussions with UEFA around the regulations. Look, I think multi-club ownership is a great example of what I just was talking about, the need for clarity, that provided there are a clear, comprehensible set of rules that investors can then work with and operate under. I think most people would agree that having, at least in the men's game, some form of control is important to ensure integrity and the perception of integrity, which is important for fans. And exactly where those levels are and where the controls are, I think we need clarity, which I think UEFA are going to introduce soon. I will just add quickly, I think in relation to women's football, there's a strong argument that the rules should be completely different. That ultimately women's football is at a growth stage and it's going to require investment and support. And if you look at, let's say, the MLS, when that launched, the first 5 years of the MLS, there was 2 entities owned 9 teams because they were the entities who invested, and look where the MLS is now. And I think women's football is more comparable to that than a mature league like the Men's Champions League. So that serves some thought.
Audience, Tom, while we wait for someone to ask a question there's a couple questions for you, and they all kind of pertain to what attracted you. Maybe if you can, at an embryonic level, explain what attracted you to Birmingham City, and what do prospective owners look for as someone who's a relatively new owner in the space?
I think, for us at least, when we're thinking about an investment, we want to make sure that it's consistent with our mandate, which is, to help businesses turn around and do better. And then the second is, can we, if we're taking a controlling interest in it, which is what this investment required, can we actually affect positive change without doing harm? And Birmingham fit the bill on both counts. And so that was a really important component. And from a attractiveness perspective, we saw a massive brand that, as I said earlier, was really left to, to sort of waste away to a degree in the context of how that product was delivered to its constituents. So there was just, it fit, it had the right characteristics, and it was something that we thought we could make a positive change on.
Okay. One more question from the audience. We got a hand there.
Thank you. Why does the panel, or what was the panel's view on why, from private equity interest in investing in this space, it's predominantly US as opposed to, let's say, European-based private equity? Is it an appetite for risk from a US perspective versus European private equity funds?
In terms of, can you just clarify, do you mean in terms of teams itself? In terms of, or because...
Because of investors coming into the space being predominantly US as opposed to European-based.
I would just say CVC obviously is European and massive in media rights, but yeah, I guess with Clear Lake in particular, I mean, Ares, what do you...
I think that's probably going to evolve, is my sense. I think the US maybe has more engagement today, but I suspect Europe will be not far behind in participating. And the private equity firm or the asset manager will probably have different flavors of how they get involved, but I can assure you there's more constituents coming to the table in the next couple of years.
One more? One more quick one? Or do we just want Ibra? All right, we'll wrap up a bit early so we can enjoy the next session. But thank you all for everything, and thank you to the panelists.